out of the range of possibility according to our own forecast at the Cleveland Fed. We're putting together scenarios right now. Of course, how things play out really are going to depend on the course of the virus. So the virus is really, and how well the U.S. economy can sort of contain, or not the economy, but the U.S. healthcare system can contain the virus and spread out and flatten that curve. So right now, in terms of the economic repercussions, we've actually, told people to stay home, close your businesses, and that's the right thing to do given the severity of the situation we find ourselves in. So it's not unreasonable to think that we're going to see some really bad economic numbers coming out of that in terms of unemployment claims, in terms of people who are not on payrolls and losing their jobs, in terms of economic activity declining. We've basically told people that that's an investment in public health. So I expect to see some very bad numbers coming out of the economy in the first quarter, the second quarter, and then what it looks like coming out of it. It's going to really depend on how the virus proceeds and the success of the social distancing and the other tasks that we're doing now in terms of kind of keeping things contained.
And how bad do you expect unemployment to get?
So there's a range of estimates. As you know, Jim Bullard, one of my colleagues, has put a range of between 10% and all the way up to 30%. We probably are estimating in Cleveland Fed not the 30% number, but certainly something north of 10%, which is reasonable given that we've shut down a lot of parts of the economy. I would say that the way to think about this is not a typical recession in the sense that, right, we've told people that we want people to be not doing economic activity. And, part of the goal now is to offer the kind of lending and making sure that the financial markets stay liquid and making sure that they stay a firm foundation, and then bridging people, right, from the economy, which in February looked very good, right, through this period of uncertainty and sort of the pandemic spread and then the containment, so that when we get to the other side of this, whenever that will be, and that'll be dictated by the virus, that the economy and economic activity can come back. So, I think of what we're asking people to do as an investment in public health, and then we're making sure, and I credit the federal government as well as what the Fed's doing, is trying to make sure that we support people, right, who are making that investment in public health, so that when we get to the other side of this, economic activity can pick up, so that people, have the wherewithal to pick up from where they were, and then the economy can move up.
The Fed has already done quite a bit. It's slashed interest rates. It's out there buying all manner of assets and funding them. Is there any limit in your mind to how big the Federal Reserve balance sheet can get? I've seen estimates of $9 or $10 trillion from the current level of around $5 trillion.
Well, look, some of the things that we're doing have Treasury backing in terms of our 13.3 facilities. These are the special facilities we've set up to make sure that the financial markets are functioning well. And so we have that backing from Treasury, and therefore we can expand our balance sheet. Other things we're doing are making sure that the Treasury market, which is the foundational market of much of the world's economy, stays working well. And I'm fully supportive of all the things that we've been doing to make sure that these markets stay functioning. The mortgage-backed security market as well. We're buying agency-backed mortgage-backed security. So if you want me to extend the bridge metaphor, right, the foundation on the edges of the bridge are making sure that the markets can function. Not that we're setting prices necessarily, but we're making sure that we're adding liquidity so that we have this foundation. And then the bridge are the things that the federal government is doing, and some of the things that we haven't laid out yet in terms of the Main Street lending facility, so that credit continues to flow to households and to small businesses and medium-sized businesses and large businesses. So the actions we're taking, I think, are totally appropriate here to make sure that we can get, right, the economy, support people as we go through this shutdown of activity, and then support them as we come out of it, and so that the economy can get back to the strength, and so that we're not damaging the fundamentals that were very strong before the virus hit.
Yeah, I sort of have a follow-up to that, President Mester. It's Sarah Eisen. Thanks for being on the show. How long do you think the economy can be in this state of a sudden stop, a deep freeze? How many months before we all have to adjust our expectations, before those Q3 forecasts won't show a rebound, and before the Fed has to think about what else it can possibly do?
Right. So that's a question about the virus. I'm not a medical doctor. I can only take what the experts are telling us about how this might play out. And I think we just have to really look to the CDC and the other medical experts about how they see the virus moving out. And we just have to be prepared, right, for whatever they come up with as being the right model in terms of when it'll be over and when we can get people back to working. So I think we can't put a time limit on it. I think we have to just take what the best scientists are telling us in terms of how that's going to play out and be prepared to help the people who are bearing the brunt of this this limiting of activity. In the end, right, it's the right thing to do because this is a very serious situation that we find ourselves in. We want to make sure that we don't overwhelm the healthcare system, right? And that'll actually save lives. But in the meantime, right, it does mean that we're going to see, right, some businesses, and people really need our help. And so one of the things that we're trying to do is make sure that from the Fed's point of view, we're doing all we can to support people, households, small businesses, medium-sized businesses, the financial markets to make sure they continue to function so that, again, whenever the time is, right, when the healthcare workers say, yes, we see the brunt over, people can start going back to normal activity, we're ready there, and then we're ready to support that economy as it picks back up.
President Mester, clearly banks weren't the cause of this crisis, but they have an important role to play in getting credit to the companies that need it in order to get through the crisis. Given that, in the meantime, should they suspend their dividends like European banks have done and indeed like US banks have done with their buybacks? And on the flip side to that, should the Fed help where it can and should it temporarily release Wells Fargo from its current asset cap?
So these are important questions. I mean, one of the things that makes us, in a better spot than some other countries is that our banking system was strong coming into this in the terms of its capital levels and its liquidity buffers. And one of the other actions the Fed has taken along with other federal regulators is to really encourage the banks to continue lending. And so we have a stress test coming up that'll, have a scenario in there that'll be a stress scenario for the banks to work through. And that'll be informative about capital levels now, given the new situation we find ourselves in. So I don't think we can say now, right, what the right thing to do on that is. We're going to get some information in a month or so about that. But what my message is that at least coming into this, we had a strong banking system, and I think that puts us in a better foundation for when we get out of this. We are encouraging banks to lend. We want them to be lending to small businesses. The banks I'm talking to, they want to be doing that. They want to help customers. And they've all set up programs to allow, deferment of payments and deferring of both principal and interest payments and loans. So, they want to be able to help their customers continue to get through this. And it really is an all hands on deck kind of situation. I think everyone's trying to do their part to help the economy and people and households get through
it. President Mester, you voted against one of the rate cuts the Federal Reserve has done here. I wonder if you regret that vote that you took.
So I don't regret it. And the reason I didn't support cutting it all the way to zero at that point is, remember, that was when the financial markets were not well functioning. I was fully supportive of doing everything we could to get those markets functioning, because a low interest rate doesn't transmit into the economy if the financial markets aren't functioning well. And so my emphasis was, let's do more on the side of trying to shore up the financial markets. And what we saw after that was the financial markets did start to improving. They're still, we're still monitoring to make sure there aren't pockets that we will, need to sort of keep our eye on about where the dysfunction is. And they have improved in certain respects. But I think to have monetary policy and an interest rate cut to actually do good, right? You need to have the transmission mechanism of that policy through the economy working. So that was my focus. And you also need to be in a place where people are spending. So right now with this shutdown and social distancing, I think it has less bang for the buck. But certainly, obviously I wasn't in the majority there, and I certainly respect my colleagues who wanted to bring it down to zero at that point, even knowing that, the focus really had to be on making sure that we kept the markets liquid and we could fix the dysfunction. I'm happy to say that some of our actions are having that beneficial effect and that the markets seem to be better working now than they were then.